Hello, everyone. Thank you very much for joining us today. My name is Daharsh. I'm with Advanta IRA, and this is another one of our educational webinars. We're here today to bring you hotel investing, passive assets for your IRA. Again, my name is Daharsh, and today my guest presenter is Danny Frye, who is the COO of Tempest22. Danny served in the U.S. Army as a combat engineer and civil affairs specialist for 20 years. Following his career in the military, Danny pursued his passion for real estate as an investor and broker. His first year in real estate, Danny co-founded Paradise Capital Investments, was awarded Rookie of the Year for Exit Realty Preferred, selected by Top 100 magazine as one of the top 100 people in real estate, and established the commercial real estate division of Exit Realty Preferred. He's currently the co-founder of COO of Tempest22, as I mentioned, which is a private equity company with a focus on value-add hotels. I've been networking with Tempest22, Danny and his team for several months now, and I'm very happy to bring him on today to share hotel investing as a topic with our audience. So Danny, thank you so much for joining me. Any other words you'd like to add about your background or experience in the investment world?
Hey, thanks a lot, Corey. That's a great introduction. I really have nothing to add more about my background. I'm just here to add value where I can. Thank you.
Perfect. Well, we appreciate having you, and I'm sure we'll get some great value out of your expertise. For the audience participating live with us today, I do want to let you know you are going to be muted through the duration of the webinar, but we do encourage your participation. So if you look at your GoToWebinar panel, you should see a box labeled questions. I'd love for you to use that to add any questions that you have as Danny or I are presenting. We will address them as they relate to the presentation, and if anything is relative to the topics, but not relative to the specific part we're presenting on, we'll address those at the end of the session as well. One other quick note, if you're someone that's interested in having a copy of today's presentation slides, I've already added that as a PDF in the handouts portion of the GoToWebinar panel that you should see, or you could email Danny or I directly for a copy of the presentation. We both have it, and we'll be very happy to share it with you. And also, final touch on that, the recording of this webinar will be posted on Advanta's YouTube page within about 24 hours of live recording, which is today, June 15th of 2023. So today's overall agenda for the webinar, I'm going to be covering what is a self-directed retirement account, why investors choose to use them, and how simple it is to start one up. I'm going to go into a case study on investing into a syndication deal like a hotel investment that Tempest22 puts together. And then Danny's going to go into understanding hotel investments, diving into the actual asset class, and talking about hotel investing from an investor's perspective. If there are any questions at the end, we'll go through those as well. But I'm going to go ahead and move into Advanta's background. We are a self-directed IRA administrator. We've been in business for 20 years. We've got just over $2.3 billion in assets under management held by our retirement account clients. And each client of ours gets paired with a dedicated client account manager that assists them with their questions about IRS rules and regulations and investing into different investments based on what the investment is. We will coordinate with you the requirements and executing the transaction in a hand-to-hand basis where you're just telling us what you want to do and bringing the deal to the table, and we're helping you accomplish it as simple as possible. All of our clients' funds that are not actively in an investment are insured up to FDIC limits. So any money that you don't have in a specific deal is safe, just waiting for you to make any specific investment decision regarding that money. Now, Advanta IRA puts a lot of our energy into educating people about alternative investment opportunities, options, and just the fact that it even exists. We have a very robust video library on our YouTube page. We put out 2 of these educational webinars a week on most weeks. We also have a podcast, the Alternative Investing Advantage podcast, and a blog if you're interested in retirement account investment news. please feel free to check those out. You could find them on our website or our YouTube page as mentioned. If you have not heard about self-directed investing, that's very common. Only about 4% of US-based retirement accounts are self-directed right now. And in the grand scheme of things, the figure for overall retirement accounts in the US is right around $40 trillion. So of $40 trillion that people hold in their IRAs and 401ks and other qualified retirement plans, only about 1.5 trillion or 4% of that is currently being self-directed. Again, Advanta IRA as a company and a lot of other self-directed companies out there do as much as we can to spread the knowledge and understanding that these accounts even exist. But it's always helpful for you as an investor to also share with your friends and family that you learned about self-direction and how easy it could be for people to utilize it. When you're talking about self-directed investing, you probably are familiar with your traditional and Roth IRA accounts, but there's also a number of other retirement accounts that can be self-directed. If you're a small business owner, you can look into a SEP or a simple IRA or even a solo 401k, which have higher contribution limits than your traditional or Roth IRAs and also allow you to make these types of investments. If you are someone that has a previous employer plan, so you were contributing into a 401k, a 403b, a 457, or a thrift savings plan, and you've left that employer, well, that money is really easy to move over to a self-direct account by what's known as a rollover. And it's also important to know that sometimes when you leave that employer, if you don't go move that money out, they continue to benefit from having access to your retirement funds, but they may pull you out of the profit sharing. So from the time you leave employment, you're not gaining any more in that retirement account, but they're benefiting from investing based off of the dollars you have set aside. So it's something to be mindful of and aware of, that it's very easy in a non-taxable event to move money out of existing plans into a new plan to self-direct. So there are two key ways that people fund these self-directed accounts, and they're very simple to explain to you. If you have an existing IRA, whether it's a traditional or a Roth IRA, and you want to move it to a self-directed account of the same type, you simply fill out a transfer form for the receiving company. They submit that to the company that's holding your money, and then the money's transferred via wire most of the time, sometimes a check, within roughly a week's time. If you're someone that had a previous employer plan like I just referenced, and you're moving from a 401k at a job you left into a self-directed account, that's typically done by either a direct or an indirect rollover, where you reach out and initiate a distribution from the company currently holding your retirement dollars, and you roll those in to a qualified plan with the self-directed company. That is typically facilitated in about a week and a half to 2 weeks time as a conservative estimate, and again is done mostly by you completing a distribution request, which is usually executed via a check being cut and mailed and received for deposit with the receiving company. Either of these movements of money is not a taxable event. It may trigger some taxable reporting if you're doing a rollover, but as long as the amount you take out of the first plan is the same amount that you roll into the new qualifying plan, there will be no taxable event occurring that you have to pay taxes on or be aware of. Now, why do people choose to self-direct? Again, there is a tax benefit here when you're making investments with your tax sheltered money. The investments continue to grow tax sheltered. Or if you're making investments with completely post-tax money or Roth dollars, you never pay taxes on the earnings you generate with that account and with those investments. A lot of people are getting fatigued with the stock market fluctuation. The ebbs and flows of the stock market are just seeming to weigh on people these days, where finding alternative investments and diversifying a portfolio is something more people are seeking. And then again, it's a new source of capital for people that are already doing certain investment strategies and learn, hey, I can use my retirement dollars for these types of transactions and investments I've already been making. Let me go ahead and put that money to work in this avenue that I understand better than stocks, bonds, mutual funds, whatever your registered investment advisor or financial advisor may be placing you into. And more specifically, why are IRAs and 401ks a good source of capital for today's topic of investing, hotel investing or syndication investing? It's very easy to repeat investments once you find a syndicator or a general partnership team that you're comfortable with and that you wish to keep investing into all of their upcoming deals for. If you're not expecting to use the money anytime soon, because this is retirement dollars and there's a potential taxable consequence of drawing that money out for personal use, you likely have this money that you don't plan to touch for 5 to 10 years anyway. They generate much better returns on average than your standard CDs and money market accounts. And again, with a self-directed account, there's no outside approval needed. A self-directed account administrator is not a fiduciary or financial advisor. So you make the own decisions for your retirement account. You don't have to get approval from any other financial advisor. If you've done the due diligence and decide the deal in question is worth making, you just have to tell your custodian what you want to invest into, and they will facilitate it at your discretion. Having said that, it's very important to invest with people you know. Always do your due diligence, like I just said. Join your local investor community or network, whether that's a RIA group in town, whether that's finding other meetings on Meetup or other types of groups that you can find like-minded investors to network with. Learn who is in the industry that you're interested in investing into and who has a good reputation or a less than favorable reputation, so you don't end up, after you made an investment, finding out some negative information. As a brief disclaimer, Advanta IRA does not provide any tax, legal, or financial advice. We are strictly a self-directed retirement account administrator. So we're here to help you follow the IRS's rules and regulations. We are not here to give you tax, legal, or financial advice. We can refer out for those services. But again, even if we provided you those referrals, it's your discretion to decide to work with those individuals in those necessary fields at your own discretion. I've got a very quick case study here for you on syndication investing into a hotel, and then I'm going to turn over to Danny for his coverage of the hotel space and industry as an investment opportunity. So I'm going to go ahead and get started. Right here on my cover slide, you see kind of an old beat down hotel unit. So syndication investments coming to play here. We've got an investor named Larry who has a lot of money in a managed IRA account with a fiduciary custodian. He meets Malcolm, who is an investment provider or a general partner, syndicator, a lot of common terms used for Malcolm's position, who has a hotel offering, which I just showed you, where they're going to go in, renovate, update that hotel, and try to generate some returns for the investors. Malcolm provides Larry with the subscription agreement and prospectus to review. The minimum investment is $100,000, which is commonplace. Usually with these types of investments, you see $50 minimums, $100,000 minimums, different thresholds based on what the deal is and what the partnership team has put together. But in this case, Larry reviews everything, he does his due diligence, and he decides he wants to participate. So because he doesn't have an account already, he sets up a self-directed IRA with Advanta, and he submits a custodian to custodian transfer request as part of his application. So we can move over $100,000 plus potential additional expenses for his maintenance fees and things like that into a new self-direct account. Advanta receives all that paperwork, submits the transfer form over to his previous company, whether that's T. Rowe Price, Edward Jones, Merrill Lynch, any of those other companies, and we facilitate getting that money in. In the meantime, we work with Larry and Malcolm to also get the investment paperwork in good order so we can fund this investment as efficiently and quickly as possible. So the process is that the investment paperwork or subscription documents must read the investor's name as this retirement account, not Larry as an individual. It also has to be tied through to the retirement account's tax ID number, not Larry's personal social security number, so that there's no possibility for Larry to have a personal tax consequence for making this investment or the income generated by this investment. Once that's all filled out properly and coordinated, Larry will approve all the paperwork. His account manager at Advanta will execute everything and send the funds over to Malcolm's team, and that investment's funded at that point. Moving forward, Malcolm's partnership pays an 8% preferred distribution to all subscribers on an annual basis, which breaks down to $8,000 per year being generated. And after 5 years, the project's refinanced and a large lump sum of $130,000 is a final payout made on this investment. So over the course of 5 years, Larry's investment earned $40,000 in total over the preferred distributions, and also a $30,000 additional lump sum at the end. So $70,000 have been generated after 5 years on a $100,000 investment that has grown either tax deferred or completely tax free, depending on the status of that account. Again, these numbers are rounded just for an example's sake. They are relatively reasonable though, and it's always up to you to do your due diligence on the deals you go into to make sure that the numbers that you expect are going to pan out. I see my first question just came in. Does Larry have to worry about unrelated business taxable income, or UBTI? There's common acronyms there. UBTI, UBIT, UDFI. Those are taxes that Larry may not necessarily have to worry about directly. That is going to fall more so on the general partnership team putting the deal together. If they're utilizing leverage, there are ways to mitigate the taxable nature that is correlated through to the limited partners or the retirement account in this case. So really the answer to that question posed is a case-by-case basis. That will be something to do due diligence with your syndicator team and with your account management team at Advanta to see if that's something applicable for the investment in question. So what type of investor are you? There are active investors that prefer to do hands-on investing, like managing a rental property, doing a rehab or a fix and flip, or even wholesaling real estate. That is not this type of investment strategy. While the pros are that you have more control and you are the decision maker and you are hands-on, the cons are that it's more time consuming, you spend a lot more energy and you have a lot more expenses, and there's a lot more responsibility for you. But in the type of investment we're talking about today, passive income, you're investing where you don't have any time commitment. You're not making day-to-day decisions on these hotels. You're simply generating mailbox money based on the money you've put up and the vision that you've received from the general partnership team that is making those day-to-day decisions. And ideally, as long as the project goes well, you'll generate returns that are either tax deferred or tax free. If you are more of a passive investor, then again, today's topic is for you, and hopefully Danny's information about hotel investing bodes well in your favor for learning more about that as an opportunity for you moving forward as well. So my key takeaway points today is always conduct your due diligence thoroughly. Syndication investment generates mailbox money. And then foreshadowing into Danny's portion of the presentation, be aware of your market cycles and your investment strategies. While trusting your general partnership team is a must, learning the process, which Danny's going to outline for you, is very important as well, just to understand the basis of what those general partners are doing and how your deal that you've made an investment into is ideally going to pan out. As I mentioned, it's very easy to start a self-directed account. It takes only about 15 minutes to complete an application. We pair you with an account manager that helps make things as simple as possible. And you can open, fund, and start investing with your account as a conservative estimate in about 2 weeks. Please feel free to reach out if I can answer or help you further with that. And without further ado, I'm going to go ahead and turn it over to Danny Frye with Tempest22 to cover his side of understanding hotel investing.
Thank you so much, Corey. That was some great information. Right off the bat, I just wanted to say that of all of our investors throughout all of our deals, about 30% of our investors are using a self-directed or a solo 401k. So this is investor sentiment, and so we're seeing a lot of investor sentiment changing in the direction of traditional investments. So looming recession, rate hikes, inflation, collapsing banks, global conflict, supply and demand issues, market instability, all of these things are having some impact on investor confidence. So, with that being said, we look at all types of, we like to educate a little bit on, what is the market cycle and where are different assets within the market cycles, and why would a particular asset class be something that you want to view within that market cycle. And it comes down to all of these factors that are in play with the investor confidence. Okay, so what we see here is on the left is an S&P 500 histogram that shows the timeline of the S&P 500 over a long duration period of time. I can't quite remember what the 2000, I believe, up to current. Okay, so as you see, you have growth, and then you have a dip, and then you have growth, and then you have a dip, and periodically you're going to have a big dip with, followed by usually a return to growth. So I like to use a clock acronym or a clock analogy to really explain and simplify the market cycle. So if you're looking at the 12 o'clock, that is the top of the market cycle, and the 6 being the bottom. The clock moves in a clockwise counter fashion. What you see is, as people always tell you, hey, you want to buy low and sell high, but people work on fear and emotions, and they get typically ends up, the natural gut reaction is adverse to what the tactic should be or the strategy should be in buy low and sell high. And so what happens is, as assets are improving, and climbing, people get that fear of missing out, or they want to jump on that bandwagon, and so they hop aboard. But what they're doing is they're hopping up on the upswing. Okay, and then what happens is, as it's starting to go down, as you start seeing a decline in a particular market cycle, people worry about losing their money, so they start pulling out or they start abandoning it, and it works contrary to the market cycles. So if you play a longer game versus a shorter game, you can move from market cycle to market cycle. And I like to break the clock down into thirds. So the top third is going to be the top of the market cycle. So you don't have to time it exactly right to the 12, to the pinnacle of the top of the market cycle. Anytime within that in that top area is a good time to sell an asset, right? If you sell at all. I'm a big proponent of holding everything. In that middle zone is really where you want to hold, and then that bottom zone is where you want to buy. So if we look at some of the asset classes that are out there today, where they're at in the market cycle and why they're there is, if you look at the single family housing market, it has been in decline over, the last year to 2 years, not consistently, but, more and more, we're starting to see it continue to decline down, and a lot of that has several different factors. With interest rates going up, the cost of living expense goes up substantially with with the interest rate. So the same amount of house for the same price point, there's a discrepancy between that same house and what the price point is today than it was 18 months ago, based off of the interest rate hikes going from 3.5% up to, I believe, in some cases I've seen 7.5% on single family mortgages, right? So that would take like a $300,000 house, and your buying power has shrunk down to somewhere around 180,000 on that same house, right? So the market will continue to adjust the value of those houses until it hits that stability, and usually it bottoms out. It overcorrects before going up. So if you know how to time that market, you don't have to time it the pinnacle and you don't have to time it at the bottom of the valley, you figure out the top, the thirds, right? So if you're in that middle third, you probably want to hold it, right? If you're in that top third, you probably want to sell. If you're in that bottom third, you probably want to buy it. If we look at commercial real estate, office space, multifamily real estate, you're looking at self-storage and other multifamily assets. A lot of those have fallen into this mid-range of a decline cycle, of the decline in the market cycle, and a lot of that has to do with again interest rates. A lot of banks are only issuing out variable interest rates on commercial real estate, right? Because the interest rates are changing so rapidly with periodic rate hikes. Those banks still see that the interest rates are going to continue to climb, so they don't want to shoot themselves in the foot by offering a lower interest rate this quarter when they know next quarter the rate's going to increase. So they, a lot of times what they, they're pushing these adjustable rates at 2 points over prime, right? Which is it's crippling the returns in some of these commercial markets. Particularly in the multifamily space, you're starting to see a lot of occupancy reduction, right? So if the occupancy declines, they have to lower the price to bring the occupancy back up to the acceptable occupancy rate, okay? And, again, because they've lowered the income and the expenses have gone up, that profit range is shrinking. So what's going to happen is the cap rates are going to reverse compress or expand, and it's going to reduce the price, the purchase price of these assets. But right now they're in that higher zone, and they're going to drop over a particular time. Cryptocurrency, we're seeing this a lot, and where it is down near I believe near the bottom, the absolute bottom. But that's hard to say because there's still like the SEC seems to be on seems to have declared war on cryptocurrency. And so, there's a lot of unknown future regulatory factors that have made it somewhat unstable and unpredictable on where that bottom of that cycle is going to be. Well, hotels are a little different, or a different story. It's all subject to the same philosophies and the same market cycles. And a lot of times when you see a recession or a rapid growth phase or a depression or whatever you want to call it, all these asset classes tend to converge in the same zone of the market cycle as opposed to being spread out, right? But there are different factors in the hotel cycle on why hotels are a great asset class at this time. It hit a premature bottom of the market cycle as a result of COVID-19. COVID-19 in March of 2020, travel across the country was virtually ceased for about 3-week period, and then very slowly opened back up over the course of about 9 months. And all the way up to today, we're still seeing some impacts from occupancy rates based off of what COVID had done to this market cycle. So while the hotels were hitting a 5% occupancy rate and hitting the absolute bottom of the cycle, most of the other asset classes, aside from office space, was thriving. Cryptocurrency was virtually the highest it had ever been. The stock market was on a really good run. So was single family housing. I mean, we had really explosive growth that we hadn't seen since 2006 in that shortened period of time on the value of single family homes. And rents were going up exponentially as well. I had a personal house that I had rented out for $800 a month. For the previous year, we had a changeover and it went to $1,200. So it was a substantial increase in the rental demand, which also affected those prices. Other things that continued to affect those was institutional investors shifted focus from from what their initial strategy was, because they saw the shift in the market cycles and moved into single family houses, and they paid a future value because that's what they do. They pay a future value because they're planning a long term. That overinflated the housing market. Okay, so and then you had massive compression of cap rates in the multifamily space. So all of this made drove the cycle up for all of these asset classes, while the hotel class was stagnated at the bottom because it was being regulation and travel restrictions, as well as sanitary restrictions, were causing limits to the amount of income that hotels could make. Right, you had less occupancy, so you had less patronage. You had more regulation on cleanliness, to a point to where if this hotel room was rented out tonight, it would be 3 nights before it can be rented out again for a sanitary thing. And then you could only rent out every other room or every third room, depending on what state you were in. So you saw a lot of this that really hit the market cycle early. And then you had, additionally, you have a high barrier of entry. So in order to be able to buy into a hotel, you have to have experience, right? A bank is not going to assume the risk of financing the hotel to you if you do not have experience in the hotel. Whereas in an apartment building, that's not the case. If you have the funds, you have the plan, they're going to approve it. If you have, for a hotel, the franchise will also has a say in the game. So if you want to buy that hotel, the franchise can say, hey, look, show me your experience level. Have you ever managed one? Have you ever owned one? What was the success rate on that? Okay, well, we're not going to give you the franchise agreement, and neither is the bank going to give you the loan, because of you don't meet the qualifications for us to be able to award those. Okay, so it creates that high barrier to entry. So the people that were qualified, had a lot of those were in financial disrepair because of where their existing hotels were at. They were having to carry these through a downturn, right? Which created this very unique supply and demand factor, right? Where there was an overwhelming supply and very little demand, because people had speculated on the hotel industry as being, a bad place to invest, and the qualified buyers were not positioned financially to be able to get in, to be able to get involved. All of this created the perfect storm for a buying opportunity. And if we can get the next slide, please. Okay, so why Tempest22? Right, we have a very unique investment model. We've partnered with a top field expert, one of the top 100 hotel operators in the country, with a proven track record. We are a veteran-owned organization, and where to get with a veteran-owned organization is tenacity. When we, as a military, you get into this process of planning to execute an objective, right? Whatever that is, you design, hey, this is my goal. We're going to be successful. Here's the plan. We'll adjust the plan as necessary, but we're going to be successful. It's very rare that you find a military exercise or a military mission that doesn't result in success. And that has to do, that is a culture of, it's not up to chance. It's up to a plan and an execution of that plan, and then the ability to react to adversity and adjust the plan to achieve the objective. And so, that's what you're getting with Tempest22. Is we are 3 disabled veterans with a combined total experience in the military of around 43 years. And next slide, please. Okay, so our approach when we look at these hotels is to identify an underperforming hotel in good markets, right? Acquire them at a cash flow positive, improve the property, stabilize, and dispose. And what that means is, I'm sure most of you have seen this before, that you can go to almost any town, look at a four-way intersection where there is a hotel on every corner of that intersection. Inevitably, one of those is likely underperforming the others by 20 or 30%. Okay, so that's the one that we identify. That doesn't necessarily mean it is in financial hardship. It doesn't necessarily mean that the hotel is not profitable. What it means is that it is not performing against its comp set. Okay, so what we do is we identify that one, and then we negotiate that price to where it's, to where it's cash flow positive. So we pay fair price for fair business, if that makes sense. Then we improve that property. So, as we're going in, we're starting it at a cash flow positive. We're adding an improvement. We're adding a massive improvement, and then we stabilize it. So once we've hit that peak performance, we've brought it back up to where the other three hotels are performing in that market cycle, or not that market, I'm sorry, in that market. We've brought it up to the same performance as those other people. Then we hold for a period of time, typically 18 to 36 months. That's a stabilization period. So as we bring it up to peak performance, we stabilize it over 3 years. And then, we dispose of that at a premium value. Next slide, please.
Sorry, I was muted. Danny, there is a question about the nature of cash flow positive. The question is, when you're looking at hotel investments where occupancy isn't necessarily a driving factor, is it more so the travel in that region? What actually determines cash flow positive as a converse of a hotel investment versus apartment investing, where probably part of that onset is looking at the occupancy rate?
Yeah, that's a phenomenal question. So a lot of times, hotel occupancy rates are, they vary based on submarkets. So, sometimes a decent occupancy rate is 75%. Sometimes a decent occupancy rate is 40%. Okay, so it's a match, not necessarily on the occupancy rate, but hotels, struggle along three lines, and we'll get into that in a minute. But one of those lines is right here, is the location. So if it's in a bad location, there's nothing you can really do about that. The impact of the location is crippling the productivity of the hotel. Then it goes into customer experience, which is customer service and condition. So it could be one of those factors. So even though our occupancy rate may be the same, or it may be less, or it even may be greater in some instances, but the revenue is lower from a competitive hotel. So in this case, let's say we've got a Baymont, a Holiday Inn, a La Quinta, and maybe a Red Roof Inn, right? Well, the Baymont is, might have a daily rate of $50, and everything else around there, they have lowered the rate enough to keep the occupancy up, right? While the other ones are selling at $62, $65 a night, and they're maintaining their occupancy. Okay, so that's in that customer service, customer service management and that customer experience with the condition of the hotel. The other thing is in the revenue management. So let's say that we go and we notice that the hotel is underperforming based off of the customer experience, but you don't adjust the price point, the average daily rate. You don't drop the rate down to increase your occupancy and be competitive, right? You have a lesser quality product, therefore you have to drop the price to be competitive in the same market. And a lot of times, this is something that's crucial. Managing the revenue on a day-to-day basis, it's a dynamic pricing. So if you if that revenue management isn't done to an expert level, it can get very you could lose a lot of money in this situation. And a lot of times what we see in the hotels that we pursue, this is one of the driving factors of why it is underperforming. And it's because they're ineffectively managing the revenue, setting pricing is really what this boils down to, what I mean by revenue management. And that's something that's fairly simple to adjust. And we have somebody on staff that's their sole job is the set revenue, is the set price points on these hotels. So we take it very seriously, and because we do that, we're able to position our hotel a lot better in regards to what the comp set is doing. So we're not looking at, in our projections, our numbers are not going to say, hey, we're going to outperform the competition by 10% because we have expert marketing. Now that may happen, but that's not our projections. Our projections are based off of, hey, there's 3 other hotels here that are all doing within this narrow margin of error of performance, and we're underperforming that by 30%. Let's negotiate it down to where that price point of acquisition meets where we're buying a profitable business, because we're going to have to put money into it to bring it back up to what the comp set is doing. I hope that answered your question. And we'll keep moving on, Corey, and unless they have some caveats.
No, I believe that did answer the question. I'll wait and see if they post back here in a second. So you did want me to advance to this key term slide?
Yeah, absolutely.
Perfect.
So,
all right.
Really, there's, if you're familiar with commercial real estate investing and, understanding cap rates and the flow of cash flow, hotels operate a little differently. Okay, same general principle, but there are different factors that make where you have to look at things. But in my opinion, this is way more simple, and it's a lot easier to comprehend. So, some of the key terms is ADR, or average daily rate, RevPAR, revenue per available room, occupancy rate, and gross revenue multiple, of GRM. So an average daily rate, what that boils down to is the average price per room, that you're charging, average nightly rate over a period of time. It could be in 30 days, it could be in the whole year, it could be in the trailing 12 months. It's the average daily rate of the room. All right, the revenue per available room is the actual money it produced based off of the amount of rooms that you have. So you take your average daily rate and you multiply it by your occupancy rate. So let's say your average daily rate is $100, your occupancy rate is 50%. You multiply those two together and you get $50 of a revenue per available room. If there's 100 rooms, that'll give you an idea of what the performance is. It also helps with projections, and it also helps with understanding trends. So we're looking at this report. One thing that we really enjoy in the hotel industry is this beautiful report called a STAR report, right? That I can pull this on any hotel, and it's basically a report card. So as we start from the left, it tells me what's my occupancy rate, what's my ADR, and what's my revenue per available room. It tells me what it is on the current month, the year to date, the running 12, the running 3 months. So basically what's it done in the last quarter, what's it done in the last year, what's it done year to date, what's it done to this month, right? And then it shows me how those numbers compare to the comp set and how they compare to the market index. As well as you can compare that against the year. So if you look at the bottom half of the chart, we're looking at August 2021 versus August 2020, right? So you see an increase in occupancy across the board, and our increase in occupancy is less than the comp set, from our subject property here. Our average daily rate is, these are on percentages, is 10% over what it was a year before, but it's 15%. The comp set has improved by 15%, where the index is down 4%. So, this gives us a lot of analysis in one document where we can figure out a lot of information. So if I'm looking at a comparable property or the comp set, and I'm looking at the revenue per available room, and I see that discrepancy, and if we look at the running 3 months, the comp set was doing $51 a night, or $51 RevPAR, revenue per available room. Okay, so if you take revenue per available room, multiply it by the amount of rooms, let's say it's 100, Okay, if you add 2 zeros to that, so it would be $5,106 per night over that period of time. Multiply it by 30 days or 365 days, right? That's my potential, right? I just use my room count versus their room count, right? That gives me my market potential. If I'm looking at the average daily rate, I can do the same thing. You know, there's a big gap between the average daily rate. We also look at the occupancy. Okay, so what this graph tells me is that we're not managing revenue very effective, or not we, the subject property is not managing revenue very effectively. And that's within the average daily rate. So you're seeing our average daily rate less, but our occupancy is higher, right? Which means that we can charge more to bring it up, but there's likely other factors that involved here with this property that are in the customer experience, because the discrepancy between the occupancy rate and the revenue per available room, it's really close on the occupancy rate, but it's a very wide range on the revenue per available room. So because we do have more of an occupancy rate than the comp set, we're not charging enough. And because we have less revenue per available room, you know, the customer experience is probably dictating the price, and we're just overcompensating on our average daily rate to make up for the condition. Next slide.
And Danny, another quick question. This one actually comes from me directly. When you're talking about that average daily rate, are you fluctuating it based on the need, like the case study and evaluation you had just there, on a monthly basis, or how does that compare to some of the investors on the call that may be familiar with the context of like a short-term rental, where they're adjusting it on their portals for VRBO or Airbnb? Are you handling some sort of portal or rate change as commonly as that status would be, or is this something more, I guess, on a monthly or bi-monthly status update?
Sure, let's go back to that previous slide.
Yes, sir.
Okay, so if we're looking on this slide, right, you have differing times. I just use that running 12 or that running 3. It's really a trailing 3 months, the last 90 days or so. That's what those numbers are. Now, if I look at the trailing 12, right, I can take the information from there because that gives me a bigger sample size. Okay.
Sure.
Also looking at the looking at the time frame, 2020. We're comparing this to 2020. Okay, so naturally there's a massive gain from 2020 to 2021. So a lot of times, and you can set this when you pull the data, is we like to compare the data against 2019. 2019 was the last year of stability. What you don't have is the influence and the cost of living expense increase that drives up like your annualized increase in revenue and expenses. So we convert it, we kind of compare it back to that 2019 number, and we'll look at, okay, in 2019, so you'd have that bottom line at 2019, looking at what it's doing in 2021 and how that correlation of that relationship has grown over, for the comp set, right? So we want to base everything on the comp set, but I want to make sure that it's consistent. So, if you're looking at the trailing 12 and then looking at the trailing 3 and the year to date, the current month, and it should be within a fairly narrow margin of error because this is the same submarket. So let's say it was Panama City, you have a lot of the same demand generators that are in that area, right? So it's you're looking at the same demand generators. Okay, so it should be the same. This property should be included in that comp set. Well, it is included in that comp set. It's an average of the comp of all the hotels that fit within the parameters of our search here. So we know that it can produce what the comp set's doing, because that's the average of everything within that submarket. So we just have to understand why it's not, and then fix why it's not. Does that make sense?
Got it. Yep, that makes sense. I'll go ahead and advance here the slide for you.
All right, thank you. All right, so here is a case study of the first hotel we bought. It was a Baymont Inn in Jessup, Georgia, and so we bought it for $977,000 or $997,000, right? Just under $1 million. Now, this was in September of or August of 2020, right? So it was just following some normalization back to the travel industry from the impact of the pandemic, right? 14 months before we bought this hotel, the current owners bought it at $2.4 million. So in 2019, we were able to go back and look at this particular hotel's performance in 2019, understand what the market, the demand generators were within that market or that submarket, and we're able to say, hey, look, if we do these things, we're going to increase the revenue. And that's what we did. So when we took over this hotel, 31 of 61 rooms were marketable, which means that, you had basically 30 rooms that were down for some other reason. Well, if you're at a 40% occupancy rate, or let's say a 50% occupancy rate, that puts me at 15 rooms that are selling any night, and I have another 30 of them that are down for maintenance, which means I can't make money on that. On those while they're down. So because of the impact on COVID, a lot of these were very simple and easy problems to bring the room back up to a marketable space, a marketable thing. What we were finding is that they just didn't have the liquidity to do it. So you had 12 rooms that had malfunction in the electronic locking mechanisms on the doors. Well, Jessup, Georgia does not have a locksmith that can handle that, so they were going to have to bring somebody in from Savannah, which was going to cost them a little bit of extra money. So instead of bringing that locksmith in to reset the electronic locking mechanisms on the door and rekey them, they just left them unoccupied. Right? They just they reduced those expenses. They reduced expenses in advertising and marketing, right? They reduced, which allowed the comp sets around to go up. So we were able to close it, bring the rooms back up, increase the occupancy, raise the average daily rate. Right now, it's we have it listed for sale at 1.75 million. It's been less than 3 years. If you look at our graph on the right, okay, this is a total picture of the investment. From the investor's perspective, is we raised $450,000 across our investor pool. $918 was the profit distributed in the first year, but that was part of our plan. Our plan was to take the profits from the first year and use them for the improvement capital. Well, we had $100,000, so we didn't raise the $100,000 to improve the property. We used that from the profits of the production of the property, but we had a surplus at the end of that first year. We weren't expecting to pay anything out. We paid $900. In the second year, we ended up paying out $57,000, which was well over 10% on the cash return. This year we expect to do around $50,000, and then selling it at that 1.75, we're looking at returning $734,000 in profit back to the investors. And so it gives them a net present value of the total syndication of around $342,000, which is the total profit, and around a 24% return over a 3-year period of time. Now, if we held this on, we did have a little bit of slowdown, right, from our initial projections because of the last 8 to 12 months has caused some underperforming. So we're underperforming at 24% on this asset, if that makes sense. All right, and then so this is a picture of what of the hotel, the exact hotel we were looking at. So when we bought it, the pictures on the top left is what it looked like from the street. That color scheme was no longer acceptable under the Wyndham brand. Okay, so if you look at the bottom right, that was the lobby. Okay, that also was no longer accepted. That color scheme was no longer accepted for the brand. So if you can look at the top, the comparison at the top, and then the comparison between the two corners, that's the same lobby. Okay, so these were some of the improvements that we were able to make that enhanced customer experience. Also, we brought in new management, brought in some training for the staff to make sure that they were providing a better customer experience. And then we looked at what our competition is and decide and positioned ourselves to take on more of the market share of the nightly rentable rooms in this small market. Yeah, no worries. So I know there was a lot of information in a short period of time. If you want to know some more about us, text Advanta to the number on your screen. You can email us at info@tempest22 or visit our website at tempest22.com. Nothing in the presentation is a solicitation. Everything has already been closed. Just pure value and marketing. And I defer to any questions that you may have.
Perfect, Danny. Thank you so much for covering hotel investing for our audience. No questions as of right now. I'll let people have a last minute or two to get those in. There is a question that came up earlier based on something I had mentioned in my case study. I just want to address it real quick. And if on your side, Danny, if you're comfortable in adding some input to it as well, please feel free to do so. The participant mentioned that I referenced 100,000 as a typical minimum investment amount for syndication investing. And they asked where other minimums may lie and just kind of the threshold. So from Tempest side, are you comfortable with addressing what your standard minimum is? Does it go case by case based on the deals you guys are doing? Is there further insight to that side of it that you'd like to address to the audience, or would you like that person to reach you one-to-one?
No, I feel comfortable talking about that. So it depends. It really depends on the deal. A lot of times, we have restrictions on, the SEC guidelines for our marketing. Part of it is if we have, let's say it's the 506B, we can have non-accredited investors, but we can only have 35 non-accredited investors. And we can't generally solicit, so no advertising and marketing. If we have a group, like we have right now, it's not necessarily a general solicitation. We're here going over examples. Now, non-accredited investors are going to have less money than accredited investors to invest, and we like to serve. We got into this business to really serve our friends and family and ourselves in this type of investing. This group investing, this syndication concept. And so, sometimes we'll have deals that we'll offer up for $10,000 to get into it. A lot of now, if we're doing a 506B, it's typically somewhere between $50,000 and $100,000. As the more expensive the deal is, we don't want to over inundate with the number of investors. We like to keep it at keep that manageable. So it'll vary based off of the size of the deal too.
Perfect. And that's my understanding as well, is that minimum typically is based off of the deal. It's based off of the status of the investment being a 506B or 506C, and just the overall requirements for the deal as to how much needs to be raised. So just as a general answer, and obviously a great answer from Danny on that, If any of our participants have further questions for Danny, please take down this contact information. He is a wealth of information and a great resource that would be very happy to speak with you, answer your questions, help you further, and even show you what Tempest22 has going on as a potential investment you may be able to partake in the future. Danny, thank you so much for your time, putting your presentation together for us and sharing your expertise with our audience. Any final parting words for the audience before we wrap up and sign off officially?
Yeah, thank you so much for having us, Corey. We always appreciate and enjoy anything that we do with Advanta IRA. Is such a professional company, and the communication, it makes it very simple for us to work with investors that we have in common. And I just want to thank you for the opportunity.
Of course. Well, I look forward to hopefully having you on again in the future. Maybe we could dive a little bit deeper into the topic in a few months and bring the audience some more nuggets of information about the hotel industry. So stay tuned. Check out our events page on our website. Check out our YouTube channel. And we hope you all have some happy investing. Thank you very much. We'll see you next time.